Washington in focus on Wall Street as the record stock rally resumes. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
I have a confession to make.
Yeah.
I'm kind of into this rally now.
Are you?
I know.
Oh my God, we've won you over.
I know, this is like a contrarian signal. I'm Alex Steele. We're kicking off to the closing bell here in the U.S. But I have a reason for why I'm kind of buying into it right now. The S&P is up a full 1 percentage point, but the reason why I care is you have the S&P equal weighted index up 0.7% at a record. So both indices are at a record. To me, that means potentially some more broadening out. You're also seeing yields come lower on the front end. The 2-year yield down by about 4 basis points. That's a Powell special. He did say that you're looking at the conditions that could wind up meaning a cut. That was as he talked to the Senate. And one thing to point out, too, which could be adding some nice fuel to the equity fire, is the Bloomberg Dollar Index down 0.5%, dropping like a stone, Romaine, below its 200-day, below its 50-day. And that could help juice some of the stocks, particularly those international companies.
A lot of catalysts right now helping to lift stocks, and I'm glad you put up the equal weight there. But let's go back to Jay Powell, because the Fed chair did just wrap up 2 days of testimony before U.S. lawmakers, and he made it clear that while the Fed is still inclined to cut interest rates this year, policymakers don't yet have the confidence to start that easing cycle. It was a familiar refrain from the Fed chief, but it did add a tinge of color about the timing of that first rate cut. That's a big part of the reason for the rally, enough color to spark a modest rally in treasuries as well, with 2-year yields back down around 4.5% and enough color to push stocks back up to those record high levels. Now, while Powell packs up his briefcase and heads back to the office to do his job, the president of the United States, Joe Biden, going over his notes for a big night before a joint session of Congress. The annual State of the Union address, traditionally an opportunity for the president to sell the American people on what he has accomplished and, more importantly, what he's going to do if he's reelected. On economic issues, it should, in theory, be an easy sell, right? Unemployment under 4%, GDP growth tied for the fastest among G10 nations, and inflation a fraction of what it was just 2 years ago. And yet voters, they don't seem to be giving Biden any credit for that. So a chance tonight for the president to maybe change perceptions. Bloomberg is reporting that Biden will tonight outline plans for eliminating student debt, imposing new taxes on businesses and billionaires, and creating more future-proof jobs. That speech coming just hours before the latest monthly jobs data that continue to support tighter credit spreads. And this was evident earlier today in the weekly jobless claims figures that came out, which showed, Alex, that when you count up the number of states out there showing a large annual change in unemployment claims, that's actually fallen down to just 4.
Right. So, okay, maybe I'm feeling better about the rally. I have another chart for you that kind of says something similar in terms of maybe why I'm feeling better. So there's 2 lines here. I don't know if you can see this light blue line, but that's the important one. So the white line is overall job openings. We got that from the JOLTS yesterday. And this is a hat tip to Dan Curtis, the awesome guy who works in London, who's the chart maven. And the blue line is what's important. That's job openings in companies with over 9 employees. So it's really about sort of medium-sized, small businesses. Their job openings are actually holding up quite well, which means maybe it's actually the smaller companies that are doing pretty well. The Fed also had a result out today in a survey that says that small companies are most optimistic than they've been in a while, despite high debt burdens and despite rising interest rates. So, Romaine, that's why I feel a little bit better.
Yeah, absolutely. And I think some of the comments we got out of Jay Powell certainly made the market feel better as well. He just did wrap up his second day of testimony. Take a listen as to what he had to say.
I think we're in the right place, which is we're waiting to become more confident that inflation is moving sustainably at 2%. Mm-hmm. When we do get that confidence, and we're not far from it, it'll be appropriate to begin to dial back the level of restriction so that we don't, drive the economy into recession rather than normalizing policy as the economy gets back to normal.
The chairman of the Federal Reserve there sort of providing a bit of a roadmap, if you will, as much as he will do publicly here for the markets. That's putting a bid under stocks. You're seeing also a bid come in to the fixed income market as well. And a lot of people right now looking at credit conditions and seeing things maybe a bit more ideal than what they looked like just a few months ago. Bonnie Wangachul joining us right now, portfolio manager and head of ESG investments at Western Asset Management, to help kick us off to the close. Bonnie, thanks for being with us here. And I am curious here about the rotation that we've seen around asset classes, whether it's in equities themselves or in the credit space, where a lot of people had started to embrace the longer end of that fixed income curve. I'm told that you think that maybe it's time to maybe move a little bit shorter duration.
So yes, generally we have been pretty constructive on corporate credit overall, both within investment grade and high yield. And that's because we have viewed this economy as one that's fundamentally very sound and very resilient. But specifically along the yield curve, within the longer dated end of investment grade credit, we felt that spreads there in general had tightened basically to what we view as fair value, and in some cases inside of that. So we have been taking the opportunity to move out of some of those positions in our client portfolios into areas that we think provide better value and some downside risk in case some scenarios play out that we're not expecting. Our view is that we are going into a soft landing, that growth will moderate and inflation will continue to decline, but we certainly want to protect against other scenarios as well.
As far as though finding that value, I mean, it's one thing to adjust duration. What about actual risk levels themselves? I mean, there's been a lot of discussion here that given how tight credit spreads are and the anticipation that with a soft economic landing, those worst case scenarios in the credit space may not materialize. Does that give you more of a green light to embrace some of those high yield issuers?
I think it's very issuer selective. So our team is looking very hard at it on a case-by-case basis. Certainly, some issuers are more attractive, some sectors are more attractive, and that's really what we're doing at Western, is seeing where are you being compensated for that risk. Spreads have certainly come in quite a bit, but especially within the high-yield sector. But we're looking at that on a credit quality adjusted basis. It's really not as tight as people think.
What's interesting is you look at productivity, say, here in the U.S., and the sectors that seem to benefit from rising productivity are considered more of the value sectors, right? Which can, like industrials, for example, transports, which in theory would have more debt. Is that actually providing the opportunity right now? So
leverage in general is lower, I think, because a lot of companies have refinanced into this lower rate environment. We're seeing a little bit of that creep up here and there. So again, you just have to pick your spots. I think in general that you can't look at this market, particularly at these spread levels, in a monolithic way. You really have to be an active manager.
So going with what Maria was saying about sort of duration versus the short end, one interesting point from Powell today was kind of just that maybe it would make sense to reduce the longer duration. They used to have more in T-bills than they do now, and sort of maybe adding to that at the expense of duration. Do you think that that's sort of a structural shift, even though it'll take some time to get there? And how do you invest with that?
Well, I think that for now the Fed wants to really maintain, their QT versus the actual monetary policy and the Fed funds rate very separate and distinct. So I don't think we're going to be seeing any changes on that for now. What we do know is that the Fed is really working towards, cutting later this year. Their view is that rates are either already restrictive or will very soon become restrictive. So even despite stronger January data, the Fed has been pretty uniform, and the members have been pretty uniform in their opinion that their next move will be a cut. And as Powell said today, they're very likely at the peak in terms of policy rate. And that's something that will provide a good tailwind for fixed income later this year.
Yeah, it's certainly been what the market has wanted to hear. I guess the big sort of question mark going forward, that if the Fed does get that confidence, as Powell referred to start moving rates lower here, are we still going to be in a position where the economic backdrop is going to be supportive of that? And by what I mean by that is that can they sort of do 2 or 3 cuts, stay there and say, this is now the neutral rate, this is the baseline, or are we looking at a situation where this could be a race back to the bottom?
Well, I think we've seen some historical precedent for, that type of cycle that you just described, where you have a few cuts, insurance cuts, whatever you want to call them, and then kind of a pause. We've seen that be, again, a good environment for fixed income. I think that's what's basically being priced into the market right now, which is pretty close to the Fed's type of estimates. We'll see how this evolves. I think it's going to be very data dependent, not only for us as investors, but also for the Fed, frankly, as this year plays out.
All right, Bonnie, always great to talk to you. Bonnie Wong-Cool there, portfolio manager and head of ESG investments at Western Asset Management, helping us kick off to the close. here on this Thursday afternoon. And coming up, a discussion here about demand for live entertainment. We're going to speak to the man behind the likes of Disney on Ice and the Ringling Brothers Circus, Ken Feld of Feld Entertainment, joining us to discuss how the sector is faring amid higher ticket prices.
Never seen Disney on Ice, but circuses, you bet. All right, plus you got shares of Novo Nordisk not slimming down, hitting a record high on optimism around its obesity pill. This time, it's the stock of the hour.
Yeah, I have to break it to you. Disney on Ice is just a circus on ice. And a big test for Broadcom coming up. A gain of over 50% since the company's last earnings release. The stakes are high for the next earnings release coming later tonight. We're going to break down what to watch. John Vinn over at KeyBank going to be joining us. All that and more coming up in just a bit. This is The Close on Bloomberg.
Today, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Powers, Joe Matthew and Kaylee Lyons will bring you live global coverage starting at 8:30 p.m. Eastern. Bloomberg, context changes everything.
All right, this is why I'm a little less negative, less skeptical on the rally right now. The equal-weighted S&P index finally setting a new record for the first time in 2 years. This shows the S&P versus the equal-weighted index. Yes, the S&P is outpacing, however, a record high for both. So let's get more into kind of value and what do you do with that information? Chris Davis, Chairman and CEO of Davis Advisors. We're making a lot of hay about breadth, and is it good and is it bad? Is this the time for value?
Well, I think that value is, I always say, a strange definition because nobody would intentionally buy something that was overvalued, right? So growth is a component of value. And I think what's happened is there's been so much focus on momentum on what's already gone up that a gap has opened up in economics between businesses that are profitable and, all money's green. And the value of a business is how much green it generates over the course of your holding period. And so I do think there was too big a gap between some parts of the market and others. And whether we call that value versus growth or not, it certainly does seem to be broadening out that way.
So where we were waiting was kind of small caps to catch up, more of the cyclical, deeper value names like, I don't know if you want energy or industrials, et cetera. Is that where you want to be right now?
I think financials. I think that, financials really since the financial crisis, every time there's a whiff of economic uncertainty, people just panic out. They expect a financial crisis around the corner without thinking that was really almost a once-a-century event, certainly once every 60 years. You haven't had a banking crisis like that since the Depression. And the result is that financials and really select banks have kept earning more and more year after year after year after year. They've built their capital. They've gotten safer year after year after year. And yet their relative discount to the market has gotten wider and wider and wider. Yeah. So my view is that's really where the biggest opportunity is. But you better be selective because you don't want to end up with First Republic.
Well, let's talk about the selective nature of that because not all banks are alike. I mean, obviously you have the big money center banks. I mean, look, JP Morgan isn't going anywhere. Yeah. They're pumping out cash better than anyone. They're going to be around. Go down a tier, though. What are we talking about? What's attractive to you there?
Well, I started our financial fund 30 years ago, over 30 years ago. And back then, it was always easy. You bought small banks that were selective because they were better managed. They grew better. They had, And for the first time in my entire career, I actually think the big banks deserve a premium. They deserve a premium because they have a lot more capital. They have a lot more diversification. They're more tightly regulated, and they have less relative credit risk than the smaller banks. So when you go down to the next tier, certainly there's a tier right below the biggest, U.S. Bancorp, PNC. Fabulous. Once you get down to smaller banks, then you have huge disadvantages, not just diversification. Think of technology spending. How do you apply AI when you're a small bank? How do you build your internet presence? And so the big banks, for the first time in my career, have really developed true competitive advantages and deserve a premium.
So financials is a big one for you. You mentioned AI. I think that's going to be a big one for everyone. What about in the EV space? Because there's been so much talk about the sort of the genesis of this EV revolution, which at least for right now seems to be maybe hitting a speed bump, let's just call it. And a lot of the same concerns about AI, that this is such a narrow rally focused on NVIDIA. That was the same conversation with Tesla, right? It was like if you wanted to invest in the EV space, there was kind of one game in town, at least up until about 2 years ago.
Yeah. Well, I mean, a little bit like Alex and I were saying about growth and value. You know, whenever there is a trend that is undeniable, the growth of the internet, the growth of AI, the electrification of the auto fleet, you know those things are going to happen. And investors pile into whatever is the first derivative play on that. And I would say, when I look at EV, I think the safest place to be is copper, right?
Copper.
Yeah, because it goes into all this stuff.
Electrification, you think of companies like tech, you have an asset that if it was your family asset, you would pass it to your grandchildren. You have long-lived assets. You have copper is, of course, going to grow as a percentage of the economy. Supply shrunk for decades because nobody was interested in commodities. So I think we tend to think that way. And similarly with things like AI, we think, who are the beneficiaries? And going back to financials, what I can tell you, if the story I read on Bloomberg yesterday was true, where they had an AI, JP Morgan announced an AI application for customers in cash management that eliminated. Think of what that means for just the cost structure of our banks. So, and again, the biggest banks. So that's how I think of applying those things.
All right, Chris, we got to get you back to talk about some of these other themes. Gonna have to leave it there for today. Chris Davis, Chairman and CEO over at Davis Advisors. All right, coming up, he was just talking about AI. We are going to talk about that AI rally and a big test tonight as chipmaker Broadcom gears up to report its latest earnings. We're going to break down what to expect after the break. This is The Close on Bloomberg. All right, time now for our top calls. The big movers on the back of analyst recommendations, and we start off with Akamai, getting an upgrade over at Baird to outperform, with the analyst saying, take advantage of recent weakness. That's his quote, saying that with the stock trading below its 5- and 10-year average valuations, there is an opportunity there. He sees strong growth ahead for Akamai's security business and untapped potential in the compute segment. Also lifting the price target to 135 from 128, investors lifting the shares by 2.5% on the day. Next up, let's take a look at Victoria's Secret. An awful day here. JP Morgan downgrading to underweight following a lackluster Q4 report. The retailer sales, they just haven't improved, and the analyst says margins are going to continue to be constrained in the next 1 to 2 years with limited visibility to return to top-line growth. That price target also dropping down to $15 from 22. The shares having their worst day since they returned to the public market in 2021. And finally, Micron, an upgrade to buy from hold. This over at Stifel, a new price target of 120. The analyst Brian Chin says Wall Street has underestimated the memory chip maker's earnings potential, particularly for the upcoming fiscal 2025 year. He sees Micron going through a sweet spot right now that leads to a production ramp up for high bandwidth memory chips for use in AI. Those shares moving higher on the day by about 3%, and those are some of our top calls. We do want to stay in the chip sector and with the focus on AI, with Broadcom set to report earnings after the bell. It's going to be the next big test for the AI rally. John Vinh joining us right now, Managing Director and Equity Research Analyst at KeyBank. John has a $1,200 price target on the stock and an overweight recommendation. All right, John, I never really know where to start anymore with Broadcom. There's so many things going on with this company, from its legacy business to the new promise with AI to all the drama surrounding their various M&A activity, or lack of it, if you will. What's going to be most important to you tonight?
I think the key focus is going to be kind of two things. Obviously, it's going to be the performance of their AI business, which is obviously highly levered to Google's TPU, right? They are the ASIC provider for Google's TPU, and they also provide networking component for the broader AI supply chain. So they're going to be broadly levered to AI. Second thing that investors are going to be focused on is just the execution of their latest acquisition of VMware, right? So Broadcom is known for extracting significant cost synergies from their acquisition, driving 60% EBITDA margins, and obviously raising pricing on their customer base going forward.
And so when it comes to what they articulate in terms of not just the promise of AI, but the substance, the idea here that whatever demand they might be seeing, whatever long-term promise they might be having, that is going to show up in the bottom line numbers? Are we going to see that in this report or maybe in the next couple of earnings reports, or do we have to wait longer than that?
I think you're going to absolutely see those synergies start to show up in this quarter, right? It's, these things take time. They provide a full year outlook, but you're absolutely going to start to see those synergies show up on the byline in this report, and according to our view.
What's going to be the softest stuff here? Like, what are the worry points to look out for, John?
Yeah, it's going to be the non-enterprise networking. Broadband is going through an inventory correction. And enterprise storage. Enterprise storage is, quite soft. It's tied to the broader enterprise IT budgets, which we know are softer entering the year. So those are going to be the offsets to the strength that you're going to see in AI.
Who are the main competitors at this point with Broadcom, and what did we learn from their quarters?
Yeah, we're they're going to compete against, probably the closest comp is going to be Marvell. Marvell competes with them both on the networking front. Marvell also competes with them on the AI ASIC front, right? Helping their customers develop custom ASICs. And then you also have to look more broadly and recognize that NVIDIA is kind of one of their competitors as well. I mean, NVIDIA focus on providing merchant AI GPU silicon to all hyperscalers versus Broadcom, which is focused on providing custom silicon.
Why don't you think, though, we've seen maybe a little bit more excitement about Broadcom's AI strategy? I sort of understand exactly what's going on with NVIDIA, or at least why people are so enamored with them, even in AMD, even in Microsoft here. You just don't see Hock Tan and his team getting the same type of attention or the same type of credit for pushing into this space. Is it simply because they're behind, or people don't understand the story?
I actually think you are. It is still one of the top performing stocks within the semiconductor space this year. You definitely have seen a re-rating in the multiple by a couple turns over the last year or so, and we think that is in part for them getting credit for AI here. Maybe the question, I think maybe what you're asking is, why aren't they trading at a similar multiple to NVIDIA?
Yeah.
The answer is that they're just a lot more diversified, right? I mean, AI is, data center business is, over half of NVIDIA's business, where, AI for Broadcom is going to be, less than 15% of their revenues.
All right, John, thanks a lot. Really appreciate it. John Vin of KeyBank. It's like when you're too big, then you make the argument that, though, you're not getting the pure play, but then at the same time, when something goes down in one of the businesses, then, okay, you make up for it otherwise. But the stock hit a 52-week high this week, too.
Yeah,
wonder expectation-wise.
It's doing fine. Look, it's up 25% to start the year, which for, 2.5 months or whatever we are into the year here, that's phenomenal by any stretch of imagination. Of course, NVIDIA's up 86%, AMD's up 40-something%, et cetera, et cetera. And I think that's more what I'm getting at. It's not so much that they haven't returned to investors, is that it's not commensurate with what you're seeing with the others.
So I guess I wonder how you, what would be success then on that front? If you're not going to be able to deliver the same kind of numbers as NVIDIA, but it doesn't mean you're not delivering anything at all. Is there more value there?
I feel like the story is important, right? Because you think about the success of Jensen Huang. Is that just because they have a ton of orders, or because he's really woven a great narrative about the promise for NVIDIA?
And maybe we'll see that. All right, really cool. All right, coming up, the man behind the Ringling Brothers and Barnum & Bailey Circus, Kenneth Feld, Feld Entertainment CEO,
awesome.
joining us next on The Close. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Are you watching State of the Union tonight?
Yeah, I always say I'm not going to do it, and then of course I end up watching it.
Are you watching the Oscars on Sunday?
I will. I can say with certainty I will not.
Okay,
yes.
Romaine is a perfect example of pretty much the rest of the United States. So this is an amazing chart that came from Mike McKee.
Wait, I'm in line with the rest of the United States?
You are
That's
totally
the first time
in line.
anyone in my life has ever said that.
This is happening.
Yeah.
So Mike McKee
I feel blessed.
digs into data, goes down these deep holes, and then emails me stuff. And this is one of the things that he emailed me, which I loved, and that's taking a look at the viewership for Oscars versus State of the Union. Surprisingly, the blue line is what we're seeing when it comes to State of the Union. The white is the Oscars. Basically means the 27 plus million viewers watched State of the Union, where those 18 million watched the Oscars last year. So you were an example.
This chart and the fact that you and him were emailing this to each other in the middle of the night is exactly why I love working here, because it's just the biggest group of data nerds in the world that you're going to find right here at 731 Lexington. So I love this chart, though. And I was surprised by that. I mean, I guess it kind of makes sense because, in theory, the State of the Union matters more to your life than whatever the heck's going to happen on the Oscar stage. So you maybe have a more vested interest in paying attention to that.
What I want to know, and maybe this is the thing for Mike, is demographics. So what kind of age range is watching?
I would say old and older.
But we don't know.
Yeah.
I mean, maybe not. Like if you have 20-year-olds coming in and watching State of the Union, then we got ourselves something good.
Yeah, but we'll see. I mean, maybe the Oscars bounces back. I mean, the Oscars has kind of been on decline for the last few years. I don't know.
I think people are hoping that Barbie Mania will do something on Sunday.
Yeah, I love that movie.
Yeah, he didn't watch it. You didn't watch it.
I did. My wife forced me, actually.
Movie. All right, anyway, let's stay with it. Let's not get into this. And we're going to fight. It's going to get ugly. All right, let's go to broader entertainment here. Our next guest is a huge player in the live entertainment space. Kenneth Feld is the man behind acts like Ringling Brothers and Barnum Bailey Circus, Disney on Ice. It's a family-owned business and has been such for decades and entertained over 700 million people all across the globe. Also has some entertainment in Las Vegas at the Mirage. Siegfried and Roy's really started that in 1990. Created Feld Motorsports with the acquisition of Monster Jam. I could go on for a while, but maybe we could just go to Kenneth first. Kenneth, hey, it's really great to see you. Thank you so much for joining us.
Thank you for having me on the show.
So I just want to get an idea of what's demand like for everything that you put out there? Taylor Swift has just rejuvenated the globe when it comes to her power of live events. Are you noticing something similar from monster trucks to Disney on Ice to circus?
We have seen since the pandemic, a great resurgence in live entertainment because it's something that you can't replicate. I mean, you have to go, you have to be there, and it touches really every emotion in all of our live entertainment. So it's been doing great, and it continues to. And 6 months ago, we premiered Ringling Brothers, Barnum and Bailey, and we had gone on a hiatus almost 7 years ago. And so we rethought that, reimagined it, and brought it back, and we've now been on tour for almost 6 months, and every week it gets better and better.
Looking forward to it, very much so. Kenneth, talk to me a little bit. You mentioned demand is super strong. What's it cost to put on stuff like this nowadays, and sort of how much can you charge? Talk me through that dynamic.
So we're geared for families, and we want to be affordable for everyone, and so we price accordingly. So every city may be different pricing, depends on where we are geographically. But an average ticket price for Ringling Brothers, Barnum Bailey, I mean, you could go and get the entire VIP thing, but for $30, $32, you can see the greatest show on earth.
What exactly does that show look like now, Ken? There was a lot of discussion back in 2017 when effectively you guys kind of stopped producing the circuses for a while, for something like 5 or 6 years. You brought it back, a new look. I am curious as to how you take something as old as the Ringling Brothers Circus is, 100 plus years, and make it fresh and relevant for a completely new generation.
So it was a challenge, and we were on hiatus for almost 7 years. And during that time, we thought about what should Ringling Brothers and Barnum and Bailey be for families of today and tomorrow. What do they look for in entertainment? What is the feeling? And today you think of TikTok, but the attention span is so short. So basically, every 3.5 seconds, there is some kind of change in what we're doing. It may be with music, it may be with lighting, it may be with video, it may be with how the performers work. But it is fast-paced, and we wanted people to walk into the arena, and the first thing they would see is something unlike anything they'd ever seen or imagined. And so it was really the creation of creating a playground for all these performers to do, their incredible skills, whether it's flying trapeze, whether it's trampoline, whether it's Wheel of Destiny, and to look at it like a franchise. So we come once a year, but families should be playing Ringling every day of their life.
Well, it's certainly a spectacle, and I think the reimagining is intriguing, Ken. How much did that change the cost to produce something like that? Was it materially different than the previous iteration before you guys went on hiatus in 2017?
It was quite different because we had no infrastructure. So everything was brand new. Everything that we created, from every light, all the rigging, everything that you could imagine was brand new. So yeah, it was quite expensive, well into the millions and millions of dollars. But we have the nucleus of a show that will run for 2.5 years, this first edition, and then we'll go from there. But the audience has really received well what we brought, and it's exciting. And it's exciting to see families together in what I call enjoying simple fun. And in today's world that's so complicated, we are an answer for just having pure fun that the family can enjoy together.
All right, Ken, going to have to leave it there. Great to catch up with you. Kenneth Feld over at Feld Entertainment. Of course, known for the Ringling Brothers Circus, Disney on Ice, which you haven't seen yet, Alex.
I've not seen it.
We didn't even get a chance to ask him about the Monster Jam, Monster Trucks.
Monster Jam is your jam.
I know, it is my jam, but we ran out of time.
I would not have known that.
So, yeah. But anyway.
I like circus, except clowns.
Yeah.
They scare me.
What?
The clowns, like,
They scare you?
Yeah.
Even now? As an
Yeah.
adult?
Yeah.
Okay. All right.
No?
No.
We don't know where to go from here now.
All right, I don't know where to go from there either.
they're
So let's
scary.
just pivot
You feel me.
to talk about some of the big movers here as we get closer to the closing bells. Just about 22 minutes until those bells ring, but we already got one bell rang overseas, and that's on Novo Nordisk. Those shares overseas hitting a record high. The ADRs here also moving higher on the day. Optimism around an obesity pill. It's our stock of the hour. An explanation coming up next. This is The Close on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
All right, time now for our stock of the hour, a closer look at Novo Nordisk. Quite frankly, the stock of the year. Shares of the drug maker soaring on the news that Cigna struck a deal with the company that aims to widen coverage of GLP-1 treatments. Abigail Doolittle joining us for more on exactly what's going on here. Is this why the stock's at a record high today?
It certainly is a piece of it for sure. I mean, we have AI and then we have the weight loss drugs. And so this is, of course, in that weight loss drug coverage area. But they are really the victim of their own success in some ways because it's such a big market at this point. This stock, if you can believe it, up 256% over the last 3 years. The bulk of their revenue, nearly $200 billion by the end of this year, is these weight loss drugs. That the demand is so strong for it that the prices have skyrocketed to some extent. So this is an attempt to cap that. So their PBM, Evernorth, that's the old Express Scripts, they basically will be offering their clients, basically employers, health insurers, a 15% increase cap. Now, what doesn't make so much sense to me here, and I don't understand, maybe you guys do, is they're saying they're going to achieve this in a number of ways, including helping people with obesity and coaching. But I thought the whole point of these weight loss drugs was that it's, well, I know it's not a pill, it's a shot, but it's something that you don't really have to take the tough measures of, say, exercise or eating less. But apparently that's a piece of what this is. So
well, I think you're supposed to. I just don't know
you're supposed to.
Well, I think it curbs your appetite.
It does.
So then, therefore, like from that perspective, it it does help. So, but what's so interesting, if you do the pill, in some ways you could argue be much more accessible. And
there is a pill by now?
They are working on it. So
okay.
One of the reasons why we're looking at a record here is because a potential pill. They showed some new data showing that this treatment helped patients in early stage clinical trials shed 13% of their weight in 12 weeks.
Wow, it's incredible.
It's huge, right? Yeah. And then it's also the trickle down. Like, does it affect other kind of companies on a tangential basis?
Well, that's a great question, Alex, and it's interesting because I was talking to a doctor about how these drugs work, and it's something in your stomach where you have this sense of like real satiation is, I don't even know if that's a word, but being sated. Being full, feeling full, and that it really does work, and I think that's why people are losing so much weight. The food stocks, interestingly, today are down. Now, I didn't expect it to have so much of an impact, but I think that people are taking seriously that this could really widen the coverage of these drugs, who gets to use them. So you have the likes of J.M. Smucker down, you have the likes of Conagra, Mondelez down. I'm kind of surprised. And over the last couple of years, I was mentioning how much we do have Novo Nordisk up more than 200%. The food indexes are down. So people are, but it's also interesting because you guys have done interviews with some of these CEOs. These food CEOs, they really are saying that they're not seeing it all that much. So there's a little bit of a disconnect.
Definitely going to say that, I would think.
That's true.
Thank you very much. But off the record, but then on the other side, I was speaking with Novo Nordisk CEO, and he was saying like, people, like CEOs of those companies, call him. He wouldn't say which ones, but they call him and say, I'm freaked out. What do I need to be worried about?
Yeah, I mean, I guess they should be freaked out. I mean, if these things work the way they do, or at least the promise that they're going to work this way and we're going to be eating less or maybe potentially eating healthier, then yeah, maybe they should be worried. But that's called adaptation,
It is.
I mean, once, rode around in, horse and buggies, it will,
No
one's with clowns in the back seat, and no one's advocating for that anymore either.
No one is advocating for that.
There are a couple people in rural Pennsylvania, but that's about it.
Or maybe at the circus.
Yeah.
With the clown and the horse and buggy on that. But anyway, but Novo Nordisk, that stock definitely popping here on that news, up by as much as 7%, the most about 7%.
Yeah. Okay. All right.
Once you bring in clowns, it's over. There's nowhere to go from clowns. Am I right?
I like clowns, Alex.
That is weird. All right, coming up, we're going to count you down to the closing bells with clowns.
They bring joy.
With Melissa Brown, who will save us from this conversation, Managing Director of Applied Research over at SimCorp. This is Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Alex Steele. With 10 minutes until we get to those closing bells, Alex, we do have a bit of a rally on our hands.
Record rally,
yeah.
Equal weighted index for the S&P and the S&P.
Yeah, and that should be a good thing, right? The last few rallies that we've had to these record highs were all about the Magnificent Seven, or at least a small cohort of stocks. You got your broad-based rally now.
I do. I feel a little better about it. I mean, the SOX index, or the semi-index, is also at a record, so it's not, tech unrelated. The S&P tech index within the S&P is the best, but nonetheless, broadening is broadening. And take a look there at the KBW Bank Index, regional bank index, up by 0.2, eking out a gain despite all the drama of NYCB.
Yeah, absolutely. Here, a bit of a rebound there, and I think it shows you that investor sentiment is still tilted, well, I guess to the bullish side. There is a search for opportunity and a search for a return. The big question simply is, where do you find it and what can you stomach? Melissa Brown joining us right now, Managing Director of Applied Research over at SimCorp, joining us to help count down to the closing bell. And Melissa, I do want to start off with investor sentiment right now. I mean, can we paint that broad of a brush? Is everything really positive, at least the perceptions?
Well, the way we measure market sentiment, which is to look at the types of stocks that people are buying, it's basically been neutral for quite a while now, particularly in the U.S. It's actually better for markets outside the U.S. Than in the U.S.
So what changes that, if anything? Is there a reason that's driving that? Is that economic fundamentals, corporate fundamentals, or just valuation overall?
I think it's a combination of having some very good news, for example, on the jobs front, and then also having some not so good news on the valuation front, or, we still have a lot of geopolitical concerns that are going on. So I think you've got those two things kind of fighting each other out.
So are we in a bubble then, or no?
I don't think we're in a bubble.
Okay.
Valuations are high, but not outrageous. And where we've seen, some of the Magnificent Seven and so on, while their valuations are higher than many other stocks, they're not in the stratosphere. So it doesn't look like a bubble yet.
So I guess this is a silly question, but bubbles happen until they don't. So I guess from that perspective, it's not really when to buy, it's more when do you sell. Are you starting to have that question percolate?
Well, I mean, that question is kind of always percolating, but we are seeing more and more, I think people coming into the market, we're seeing trading volume increase for the first, with a substantial increase for the first time in a long time. The problem is that trading volume is mostly in technology names.
Oh, interesting.
And so I don't think we've necessarily gotten that last investor in yet that might suggest we're at the top of the bubble.
Yeah. Well, it's funny too. I mean, we talk about the potential for a bubble, but we also have to kind of talk about the backdrop of interest rates. Jay Powell was just on Capitol Hill for a couple of days. Look, he said what he's been saying for a while. We're probably going to cut rates this year. Don't expect too many rate cuts, and don't ask us to tell you exactly when we'll start. How much does that matter right now? What are the correlations looking like right now in the equity space and with yields?
Well, I think it actually matters more than you would expect since he hasn't changed his tone at all. But we saw yesterday and again today, markets seem to react very favorably. And so I think that investors are really hoping for that rate cut. We saw the CME Fed Watch, the probability for a rate cut go up a little bit, not a lot, but go up a little bit for a rate cut sooner.
Yeah.
So I think the markets did like that.
Well, let me flip that. I'm going to ask you the same question, but in a different way. How dependent do you think an additional leg to this rally is going to be on a downward shift in interest rates?
It's interesting because, one thing we've observed is that rates have been high for a while and, relatively high. They're not extremely high. And we've still been in a very good economy with strong jobs growth, with good corporate profits. I don't think we necessarily have to have that rate cut in order for, for the economy to continue to look pretty good.
So you feel that sentiment can stay strong even if we don't get a rate cut?
I'm not sure that sentiment would necessarily agree with me.
Okay, but the economy would agree with you? The economy would agree
I
with you?
think the economy would agree, yeah. I mean, things have been, have been looking pretty good despite relatively high rates.
Okay.
Now, companies are starting to refinance, and so we could start to see it in the profit numbers over the next few quarters.
So I guess maybe a different question is, do you need a cut for the rally to broaden even more and stay broad?
I think that, yes, I think you probably would need to see a rate cut. Right now, you've got, a relatively narrow market, despite what we're seeing today, but it's generally been fairly narrow. That's focused on a particular theme and not on, wow, we've got this great economy that makes me want to come in and buy all stocks.
But getting back to that idea, though, of investor sentiment, it's funny, as we're speaking, we were getting headlines across the Bloomberg terminal with the latest weekly data on money market accounts. That's still at a record. Still, we talk about this cash on the sidelines and whether it's going to come back and whether it's going to come back into equities here. When I see $6 trillion still sitting in, relatively high yield money market accounts at a time where people think valuations might be stretched in the market, what incentive is there to come off the sideline?
I mean, I think, what I think happens in typical ends of bull markets is that last investor says, I'm missing out. I don't want to miss out anymore. I've got the liquidity, so I'm gonna come in. And that, I think so that's where you start to see the topping out.
And if we do sort of see more confidence of those folks maybe finding better yield, better returns outside of just short-term, cash-like instruments here, do you think that money would flow into higher risk assets, meaning something like equities, or in maybe just other parts of fixed income?
I think we'll probably because the equity market is where the headlines are, and so I think that money would flow into equities, perhaps also into high yield bonds. Or other fixed income type instruments. But if rates come down, maybe they become somewhat less attractive, and equities again are attractive. So.
All right, Melissa, always great to talk to you. Melissa Brown, Managing Director of Applied Research at SimCorp, helping us count down to the closing bells. Those bells right now, Alex Steele, about 3 minutes away. We're off the highs of the day, but still some pretty strong gains here, including 1.5% on the NASDAQ and a solid % gain on the S&P 500.
Yep, and pretty much across the board, I think most indices are in the green with the exception of financials and real estate, but just by a smidge. But really, it's tech outperforming, but also communication services, but materials, consumer discretionary, all not doing terrible, doing pretty well into that jobs number. I guess my question is, for tomorrow, do you think we're going to get a number that backs up that January number, or are we going to learn that strong data in January was like a snafu?
It's so hard to say because I mean, obviously I'm not an economist, but you think about the trajectory that we've seen. I mean, it's still a downward trend in terms of lower unemployment, higher employment in terms of the actual jobs numbers themselves. Why am I supposed to believe that got arrested by one particular month?
It's true. It's true. It is quite interesting, but I wonder if we're just positioned in very much one way, right? Like there's tons of calls. Who's buying hedges? Like no one's buying downside protection, right?
And how many strategist notes have we seen raising that issue here? That could become a bugaboo for the market, but stick with us. We're going to break down all of the price action on the day as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's our global simulcast, joined right now in our television studio by Scarlett Fu, Carol Masser, and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms. Carol, coming off what had been a two-day sell-off, now flipping to a two-day rally, and we have recouped all of the losses from earlier this week.
Pretty remarkable, right?
Yeah.
It's kind of interesting in a week that's been full of Fed speak, Jay Powell speak, if you will. I am like obsessed. I'm looking at my Bloomberg with what's going on in semiconductors. I know we're going to get Broadcom after the closing bell, but again, the March higher, we're here at a record level here on individual names and also the stocks specifically. So we continue to see outperformance, or at least performing expectations, or I don't know. Expectations.
NVIDIA hitting new records today, Broadcom hitting new records. That said, Tracy McMillan over at Wells Fargo Investment Institute said that they're actually cautious in an environment like that and think that a pullback is probably due here. It's something bigger than what we saw earlier this week. She says a 10% pullback wouldn't be all that uncommon after a run-up like this.
A 10% pullback, you think about what that looks like in a name like NVIDIA, it's just a blip. One thing that's interesting here is the NASDAQ Composite and the NASDAQ 100 setting record highs in terms of intraday levels, but volume in the NASDAQ lower than the 20-day average.
What I also think, though, is if we get a 10% correction, that I feel like in some ways that would be a miracle. You take a look at the weaker dollar, Romaine, I wonder if that's just fuel to the equity fire.
Yeah, I mean, the question, though, is sort of what would drive a 10% correction? I mean, it would have to be a significant breakdown in corporate earnings or in economic conditions. I mean, whether we get a pullback or not, I don't know. Maybe we got that pullback on Monday and Tuesday. At least for right now here, investors seem to like what they see. A nice bid to stocks pretty much all across the board. The Dow Jones Industrial Average up by 130 points or 0.3%. The S&P 500 higher by about 50 points or 1%, while the NASDAQ is going to close up by 240 points or 1.5%, and the Russell 2000 getting in on the action as well with a 17-point jump, about 0.8%.
All right, to the S&P 500, folks. 367 names gaining ground on this Thursday, 136, Scarlett, to the downside.
Yeah, you look at the sector breakdown. Let's pull up the IMAP. A lot of green there with tech and communication services, each gaining at least 1.8%. In fact, all Magnificent Seven members are higher, led by NVIDIA. Materials also getting a boost, up 1.2%. Freeport-McMoRan is the big winner there. Your laggards, there are two sectors that finish in the red, and they are the financials and the real estate investment trusts.
All right, guys, let's get to some of the individual gainers, if I may, on this Thursday. New York Community Bancorp continuing its move to the upside, a gain of about 6% in today's session. It's had a three-day rally of about more than 35%. So we've seen quite a run up in the last 3 days. Of course, in the last 2 days, it's all about the news yesterday of a more than $1 billion equity infusion led by former U.S. Treasury Secretary Steven Mnuchin. Great reporting on the terminal, so you can definitely check it out. Fitch, though, also coming out today, affirming its BB+ rating on New York Community Bank and its Flagstar Bank, but said long-term profitability still remains unclear on this name. All right, another one getting a record close today. Novo Nordisk up about 9% here at the close. Company sharing promising data on an experimental daily obesity pill. So kind of moving on in terms of maybe how they treat this and how they actually, the actual treatment, if you will, to individuals. Small study, Novo said in a meeting with investors that it provides a basis for further development of the pill, boosting hopes for its future. And investors definitely doing the buy-in. Semiconductors, I mentioned earlier, on fire today. Broadcom, which will report earnings a little bit, just probably maybe about 10 minutes or so. That one finishing with a gain. Let me just bring it up there, up more than 4% here in today's session. Ahead of earnings, the semiconductor device maker's price target raised to $1,550 from $1,450 over at Mizuho Securities. And and they did maintain their buy rating. So some enthusiasm there ahead. Yep. What do you want?
I just want to throw another one in there, too, because we didn't get a chance to talk about it. But that big rally that we saw in Rivian earlier today, and I know, Alex, you had your eyes on that. It was kind of interesting. On the surface, it seemed like a bad report, the idea that they're going to close, not open this factory in Georgia. But they're also unveiling 2 new vehicles, particularly one that is going to be significantly priced lower than some of its competitors.
The R2. Is it on your list, Romaine?
Yeah, I like them. I think they're good cars.
They're pretty cool.
Yeah.
They're still very expensive.
Yeah, they are.
They're still very expensive.
We're getting there, though. We're getting there.
We're getting there. Okay. Let's talk about some of the decliners. Victoria's Secret on the list of worst performers on the day today. Shares finishing the day down by 29.7%, having their worst day, in fact, since going public back in 2021. Shares fell as much as 32%. The company did give a full-year sales guidance that fell short of estimates. The company has, of course, been working to attract and retain customers through a rebranded fashion show, expansion of swim and apparel, but those efforts have yet to pay off. And I did want to take another look at Brown-Forman, the maker of Jack Daniels. It fell yesterday.
Wow, that's the second day in a row.
Exactly.
What's going on with you, Tim?
Down by nearly 7% yesterday, finishing it down today by 3%. I will tell you guys, kind of tough to find notable decliners on a day like today.
He was struggling.
There was a lot moving.
Struggling.
There was a lot moving higher. So bear with me here. ADT, the last one I want to take a look at, the security company, falling more than 10% today, down 10.2%. The company did a secondary public offering of 65 million shares. That sent shares lower by more than 10% today. Underwriters will have a 30-day option to repurchase or to purchase up to an additional 9.75 million shares from selling holders. The company also authorized a concurrent buyback of 15 million shares from underwriters, Alex.
All right, well, taking a look at yields here, you got the 2, the 3, the 5. That's where all the action was. Buying coming in there. Not only did you have an ECB that kind of set us up for maybe a June cut, but you also had Powell talking to the Senate, not far from confidence to rate cuts, and also could see the case for shortening maturity of Fed holdings, and all of that sort of more bullish for the long end and lower yields remain.
Yeah, absolutely. And I do just want to also go back to stocks for a second, because there were a couple of interesting stories in the equity space. I thought the drop that you saw in Viking Therapeutics today on the back of that news that Novo Nordisk was developing now a weight loss pill to add, of course, to the shots that it has. And then that record drop that we saw in Victoria's Secret. Wasn't this supposed to be a turnaround story?
How I think the fundamental story is difficult with a company like that. Look, the struggles that the company's had have been well documented for years. And just because it's an independent company now and it's its own company, it doesn't mean it's not facing the struggles that it faced, when it was part of a bigger company, which is a lot of upstarts and different consumer tastes.
Yeah, we just want to wear more comfortable underwear. I mean, let's just be honest.
Read the room, folks, right?
Yeah, I mean, come on. Okay, DocuSign coming out with earnings, taking a look at the fourth quarter earnings, coming in 13 cents a share. The expectation looks to be $2. That feels like maybe those are not comparable. So we'll get to that in a moment. But subscription revenue for the fourth quarter coming in at $695.7 million. That's better than estimated. Also taking a look at the first quarter forecast on the high end, looking at $708 million. This is a better than expected report. Remember, they're cutting a bunch of their workforce as the sort of pandemic moves on, and we're also looking at more competition from Adobe, but it looks like solid results. Stock up 16%, Scar.
And just looking through the press release, actually, Tim, I know that you are always looking for artificial intelligence in the CEO commentary. There is none from Alan Thiessen, the CEO of DocuSign. Just talked about the momentum in product innovation, customer growth, financial performance, including more than doubling free cash flow year over year. And that is a consistent theme we've heard from companies across every sector, the obsession with free cash flow right now.
Hey, I wanted to draw our attention to shares of Marvell Technology down right now in the after hours by more than 12%. The company did announce a $3 billion stock repurchase. Fourth quarter net revenue coming in above estimates. Sees first quarter net revenue, though, falling short of estimates. Those estimates were for $1.37 billion, Romaine. The company's saying they're going to see revenue in the first quarter of $1.15 billion. So that falling short.
Yeah, kind of interesting to see, because, I mean, we talk about whether these companies are really benefiting from this AI boom. And, at least in the short term, you're just not really seeing that show up in the bottom line. Maybe there's a long-term story, but it's not necessarily in this report. And you look at their forecast, Tim, them here going forward is not going to show up in the current quarter as well.
Yeah, it's also tough when you've got a stock that's up 41% so far this year, so the expectations are high. So if there's any disappointment in terms of the outlook, I mean, that first quarter adjusted EPS for Marvell, 18 to 28 cents. The estimate's 41 cents. You can understand why investors, despite that $3 billion stock repurchase authorization, they're a little worried, I would say, Scarlett, about the outlook.
They're a little worried about the outlook. I mean, it just goes to show how difficult it is for semiconductor-related companies that are not directly tied to AI in the same way that an NVIDIA or an AMD is.
Does this bode not well for Broadcom then? Romain, we were just talking to an analyst, and I asked what the best competitor was to think about when it comes to Broadcom, and he was like, I guess Marvell Technologies. And I wonder, what does this mean? The stock down 10%.
Yeah, and I think we were speaking with John Vin a little bit earlier. I think the only difference between them, though, is that, as he pointed out, Broadcom, a much more diversified company than Marvell, which is much more singular. So maybe they have the same issues as Marvell, but maybe their other businesses help to account.
Just real quickly, Broadcom shares, they're up just slightly in the aftermarket, about 0.2% as we await. So we're not seeing, at least immediately, any kind of reaction to what we got from Marvell. So we'll obviously break that down.
And just real quickly before you go, keep an eye on MongoDB, guys. MDB, another software name in the AI space, a big miss on their revenue and EPS forecast.
All right, guys, the earnings continue. We're almost there, but a few more. And then, of course, we'll all be breaking, I know, on your side as well as ours, Broadcom when they come out. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We'll see you again, same time, same place, tomorrow for Beyond the Bell.
And our coverage continues right here on Bloomberg Television, keeping an eye on several earnings crossing the wire, awaiting results out of Broadcom, Gap, and a few others. Stick with us, a full breakdown when we come back after the break. This is The Close on Bloomberg.
All right, we are awaiting results from Gap, and of course, the retailer is expected to report revenue falling 1% for the quarter and total comparable sales falling more than 2%. Joining us right now for some context around those results when they do cross is Mortimer Singer. He is a managing partner at Traub Capital Partners. Morty, it's always good to speak with you. And when it comes to Gap, this is a retailer that's been struggling for a while. It can't seem to get its product right. It's had some change at the top. Given that the 90s are back in style, shouldn't this be Gap's sweet spot, cargo pants and baggy jeans and all that?
Yeah, look, I think you're right. But it does take time to move a battleship, and especially a fashion battleship. And the moves that they've made, I think, started last summer with Richard Dixon's arrival. Richard Dixon is an extraordinary executive who many people know led the turnaround of the Barbie story, which, as you know, culminated in this incredible movie that happened last year. And he is a guy who understands culture. He understands the zeitgeist that is happening. He used, across Barbie, 35 different collaborations to launch that business into where it got to, and I think everyone knows that. But I think what he has to do here, and he started by trying to put the pieces in place, starts with marketing, with attitude, with tone. But the product takes a little bit more time. And now, just coming up on these current seasons is where you'll start to see the product hit. And when the cultural zeitgeist meets the product, I think that's where you can see things come this year. And so it'll be really fascinating to watch, especially with a new designer, which I'm sure we'll talk about.
Yeah, Zach Posen hired as a new new creative director, also chief creative officer of Old Navy, which is interesting that they highlight his role at Old Navy. Does Gap have too many different business lines, whether it's the main Gap brand, Banana Republic, Old Navy, or Athleta, with Athleta in particular really struggling of late?
I don't think they do have too many lines. I think it's important to be able to touch different consumers wherever they may be. But I think it's also important not to give those consumers exactly the same product. I think that the leveraging of the zeitgeist, as I touched on earlier, will happen in similar fashions across those different companies, but it'll be completely different strategies for each of those brands. And I do think that having a designer and a design sensibility will bring, I believe, each of those three companies, and obviously one in particular, because I think Zach's going to spend most of his time at Old Navy, to really new heights, because it'll have guidance, it'll have a strategy, and I think when you couple that with the marketing topspin is really where we'll see the product flourish. But the product itself, from a merchandising perspective, is something that has to be really A1 plus. And I think Dixon and Zach will be able to do that.
I am curious here, Morty, about just kind of the evolution of brands and style overall. We've seen some brands adapt by basically following their customers. The idea that if you are a teen retailer, you just adapt to those same customer base as they move into their 20s and eventually up into their 40s, 50s, and beyonds. Some folks try to stay in that same demographic and just cater to a new cohort of folks coming into that demographic. Which one is easier?
I think it is. I think it's easy to be an expert in one's lane. The problem is, when your core customer gets older, you try to follow them. And then when you follow them, then you alienate the people behind them. And I think, if you're looking at Abercrombie and Fitch, for example, those guys have been able to reinvent that business incredibly well recently. But it wasn't without, 5 to maybe 10 years of doldrums, probably 5 years, because they tried to, morph into something bigger because they were chasing revenue. So I think one can do both of those things and expand the base, but ultimately be an expert within one's lane, like a Brandy Melville, for example, is a very powerful thing.
All right, hold that thought, Morty. We're in conversation with Morty Singer over at Traub Capital Partners. Gap earnings now crossing the wire. On the surface, they actually look relatively good. In the fourth quarter, the company reported comp sales that were unchanged, but remember, the street was looking for a drop in comp sales of about 2%, so a beat on that key metric. EPS in the quarter, a big beat there, 49 cents a share on an adjusted basis, almost double what the street was looking for at 23 cents a share. Net sales overall at $4.3 billion. That's also a beat here. And their individual businesses also did well, including Old Navy comp sales coming in at about 2% growth versus a street estimate of about 1.86%. And here's your guidance. Not a detailed guidance going forward, but they do say that first quarter net sales will be, quote, roughly flat, and that full year net sales, Scarlett, will also be roughly flat on a 52-week basis. But we should point out the street was looking for something worse.
All right. We also just want to steer away from retail for a moment here because Broadcom has just announced results as well. This is the fiscal first quarter for Broadcom, and adjusted EPS did top analyst estimates, $10.99. The consensus was for $10.42. When it comes to adjusted net revenue, $11.96 billion. On the Bloomberg terminal, the consensus estimate is $11.83 billion. So by that measure, it would be a beat. Nevertheless, you're looking at the stock down about 8% in after-hours trading because for the full year, Broadcom sees revenue of about $50 billion. And right now, the consensus estimate, as surveyed by Bloomberg, is for about $50.25 billion for 2024 full year revenue.
Costco also crossing the wire here. There's fiscal second quarter numbers coming in. It looks like a beat on the bottom line, $3.92 a share for EPS. The street was looking for $3.62, and revenue coming in at about $58.4 billion, slightly lower than what the street was looking for at $59 billion. Though we should point out overall, comp sales, if you exclude gas, up about 4.8% higher than what the street was looking for.
All right. I want to go back to Gap because we still have with us Mortimer Singer of Traub Capital Partners. And as Romain was telling us, a big beat here for Gap on the bottom line, the earnings exceeding forecasts. It's really a sign of a turnaround in progress. And this is something that investors had been looking for a while here. Morty, when we look at something like Gap, and you made a mention of Abercrombie & Fitch and how it's really delivered in terms of growing with its customer base. The payoff at Abercrombie & Fitch was 5 straight quarters of revenue growth in a stock that's really levitated. To what extent is this a strategy shift that Gap and others can mimic, or does Gap have to come up with its own version of that?
Look, I think the marriage of product through merchandising, but also marketing zeitgeist, have all been messaged through Richard Dixon in his first few months. The stock has doubled since the day he was announced, literally doubled since August. And I think that this is a really interesting strategy because marketing and product, as well as the zeitgeist that I think Zach Posen and others will bring, will, I think, propel this company because they're focusing on the fundamentals of how the business is run. And ultimately, these customers care about these products. They're very passionate about products. And omni-channel retail is alive and well, both in the mall, but also in the minds and hearts of customers everywhere. So I think they're on their way to doing some very good things at Gap Inc. And I find it fascinating.
In conversation right now with Morty Singer. He's sticking with us as we digest these results coming out of Gap right now. Shares higher by about 7% in after-hours trading. We want to bring into this conversation Mary Ross Gilbert, Senior Equity Research Analyst over at Bloomberg Intelligence. On the surface, these numbers look good, Mary. There is a turnaround story that appears to be afoot, a nascent one, though, as we should point out. Revenue, at least on a total number basis, still well below what this company was generating just a few years ago. Is this the start of something better?
It certainly is the start of something better. And you can see it, when you talk about the guidance for the year and they're looking for sales to be roughly flat, we think that gives them upside because we think they'll beat it. If you look at the first quarter, which also says, that they expect sales to be flat, we're seeing Gap. And if you look at the Gap brand comps were actually up 4% in the quarter. And of course, as you pointed out, Old Navy was up 2% in the quarter. And what we're seeing early in Q1 is Gap is still inflecting up. And we think that the campaign that they have there now, something that Morty was just talking about, they have a campaign with Jungle. It's a band out of the UK who had a big hit back on 7/4, and they created a video with that, also, putting it on TikTok on their own website. And I think that's, getting a lot of media impressions and really getting customers back in the store, especially this younger consumer that they're trying to attract.
Well, I'm glad you bring that up here because when we talk about sort of the early iteration of Gap, it really was about their marketing prowess and how they really sort of made cool. Let's just say what it was. But eventually that sort of waned, and maybe this is now the way that they get it back. I am curious about the structure of the company, though, Mary. When we talk about the different brands, Old Navy, Banana Republic, Gap, et cetera, Athleta, here, do they complement each other in this new strategy, or are they going to work against each other?
No, they complement each other. I mean, each brand is pretty distinct. Old Navy really appeals to a lower income consumer, but also grabs a higher income consumer shopping for kids. And as you know, with your own children, they kind of go through clothes very quickly because they're growing so fast. So it really has a very broad appeal, but definitely their core consumer is at the lower end. And then when you think about Gap also has sort of a wide range all the way from babies. They're known for being like the great go-to place for babies. And then also, now that they're kind of getting cool again, they sort of stand on their own. And then, of course, you have Athleta, which is in the activewear. We're still seeing some weak numbers there, going against some tough comparisons against heavy discounting. But we think in the second half of the year, we should start to see assortments improve even further. And we're seeing some already. Yeah. And then even Banana Republic, which is, continuing to elevate. Right. And again, a different consumer. So no, we think they all stand on their own, and we think that the improvements that we're already seeing, if you go online, if you go into the stores, you'll see it.
Mary, really appreciate your joining us. Mary Ross Gilbert of Bloomberg Intelligence with the instant analysis, and Morty Singer of Traub Capital Partners with the analysis on Gap. We've got much more ahead. This is The Close on Bloomberg. Time now for the top three, where we dive into the people at the center of some of the day's top stories. And first up is Senator John Kennedy of Louisiana. He questioned Fed Chair Jay Powell at the Senate Banking Committee hearing today, and he used some choice words, Romaine, because he was recounting allegations of sexual harassment at the FDIC, which confused Jay Powell, to say the least.
Yeah, choice words, meaning he dropped the F-bomb multiple times during
Among
a live
other words.
Hearing that I would think the Fed chair probably wasn't prepared to hear. I think, he was obviously trying to make a point about some of the allegations at the FDIC, but I think the colorful language he did may have did a disservice because nobody's talking about those allegations. We're just talking about his use of French.
Absolutely.
I'm going to keep an eye on someone else here, and that's Fred Tomczyk. He's the relatively new CEO over at Cboe, and Kat Doherty had a chance to sit down with him, his first interview since he took over back in September, and he was pretty blunt here. He said, this company ain't for sale. If you're looking to buy us, we're going to make it too expensive for you to do that. He also said, the SIBO itself is not going to be as acquisitive as it was under its previous leader, Ed Tilly. So we get a closer look here at what his strategy is going to be for this company.
Yeah, and of course there was some speculation that Ed Tilly's forced departure might have left the company open and vulnerable to takeovers. All right, our third person is Mike Tyson, the former heavyweight champ, going head-to-head with YouTuber turned boxing star Jake Paul, which will all be streamed on Netflix. Remember when Netflix swore it wasn't interested in live sports?
Yeah. And now,
well, that times have changed. That's
is this actual sports? I mean, I love Mike Tyson, but what is he, like 76? And Jake Paul, I guess, I don't know. You know, I'm not much for, watching two people hit each other in the face, but that looks pretty dramatic getting out of the helicopter there.
Yeah, absolutely. Yeah. It's all about the build-up, right?
Yeah, absolutely. Here.
All right.
I know you're really into sports, Scarlett, so I won't be watching Mike Tyson, Jake Paul, but I will be watching something else.
Yes, you're referring, of course, to The Deal, which is the podcast show that Alex Rodriguez and our Jason Kelly host, and it is streaming today, the second episode. The two speak with Michael Strahan in the latest episode about how the former NFL star has been able to block out the haters. Take a listen.
What really helped me, I stopped letting people criticize me who could not do my job. Mm-hmm. How are you telling me how to do my job and you could never do this job? You've never done it. As I told one reporter, last time you put on a uniform was when your mom took you trick-or-treating. You've never done this. So why am I letting you affect me and what I do for a living? And that really helped me. Just like, so now I don't care. If you can't do what I do, why am I listening to you telling me?
All right, Michael Strahan there talking about the new show, The Deal, with Alex Rodriguez and Jason Kelly. Here on The Close, stick with us when we come back. A look back on this day in history, the crypto bubble bursting and the subsequent rise from the ashes. This is Bloomberg. On a day where Bitcoin flirts once again with the record high, it's a good opportunity to look back on this day in history, 6 years ago, when a statement from the U.S. Securities and Exchange Commission sent a chill through the crypto space. Regulators, for the first time that day, publicly acknowledged that if you are a platform serving as a venue for any digital asset deemed a security, you need to register with the SEC. That key phrase, and the most contentious, was digital assets that are securities, a definition that even today has never really been fully defined. The phrase led to a lot of gloom and doom predictions for an industry that had just had one of its most notable coming out parties for any financial instrument ever. A 1,900% rally in 2017 that took Bitcoin from a price of about $900 to $20,000. But the SEC effectively burst that bubble, with the token crashing back below $10,000 by March 7, 2018, when the SEC released that regulatory guidance. That guidance came a week after U.S. regulators sent subpoenas to firms that they suspect might be violating security laws, and came a day before Japan's financial services agency ordered at least 2 exchanges to halt operations and penalize 4 others while they took a deeper look into the industry's practices. But the SEC's efforts to rein in that industry really became hindered by its own indecisiveness, its foot-dragging by Congress, and industry-led lawsuits challenging the government's oversight. Courts have been divided on the issue of digital tokens as securities. In July, a Manhattan federal judge ruled that exchange sales of Ripple's XRP didn't fall under SEC jurisdiction, but another judge that same month took the opposite view in a SEC case against Terraform. The end result has been an industry in limbo, a limbo that finally broke in January when the SEC, its hand forced by a court defeat, reluctantly approved the first spot Bitcoin ETFs. And that gets us to my question of the day. How much in net inflows has the group of 10 ETF portfolios approved attracted so far? The answer? Almost $9 billion in net inflows since going live back on January 11th. Inflows that have injected some frenetic energy into the space and opened up a massive supply-demand imbalance that pushed Bitcoin to a $69,000 record high just this month.
And I'll add to that, that $9 billion is $9 billion and growing every day. All right, let's shift now to politics, because President Joe Biden is set to deliver his State of the Union address tonight. And so here with a preview of what we can expect is Bloomberg Balance of Power co-host Kaylee Lines. Kaylee, data points to a fairly strong economy, but the perception among voters is that Biden is not managing the economy very well. So how much of a victory lap does he actually take for the economy?
Well, he's going to try his hardest, surely, Scarlett, touting legislative accomplishments that he has under his belt, under his administration, including the Inflation Reduction Act, the bipartisan infrastructure bill, also things like addressing junk fees, addressing student loan debt, and he'll make some actual policy proposals that do relate to the economy as well, including changes to tax policy. He would like to see raising the corporate tax rate to 28%, a higher tax on stock buybacks, even changing the way that we tax billionaires. So that is going to be a big part of his messaging. We'll get other specific policy proposals as well, even just straight up announcements in regard to some foreign policy. He will announce this evening that he is directing the military to build an export port in Gaza on the coast in order to expedite the flow of humanitarian aid in, essentially going around Israel, which is pretty significant. And of course, we'll expect him to address other hot button issues, immigration, probably call on Congress to pass the bipartisan deal that he agreed to, call on them to pass Ukraine aid as well, abortion likely to come up, as is just the issue of democracy, because while this is a State of the Union, it also in many ways is a campaign speech, and he will be trying to draw a contrast between himself and his likely opponent in November, Donald Trump.
Well, that's what I'm curious about here, Kaylee. I mean, this is a campaign speech. They're not going to call it that, but that's what this is. And at the end of the day, are voters going to be more enamored by some of those economic issues, by some of those geopolitical issues that you raised, or this narrative around, I guess, the decision about the future of our democracy?
Well, it's probably both and, Romaine. On the one hand, sure, voters are likely tuning in to hear specific policy to inform themselves as they get ready to choose in November who they would like to be president, whether or not Biden deserves a second term. And people we've spoken with here in Washington suggest that immigration specifically is going to be an issue that voters are keying directly into. But a lot of this also is for President Biden about addressing voter perception of his age, of his ability to carry out the duties of this job. Given at 81, he already is the oldest president we've ever seen, and he's asking for 4 more years. He would be 86 when he would leave office. So part of this is really going to be about presentation, showing he has the stamina and vitality to get through a speech such as this, and any potential missteps or gaffe he makes in this speech are likely to be replayed over and over and show up in campaign ads throughout the rest of this cycle.
Kelly Lyons, you can catch her at 5 p.m. alongside Joe Matthew on Balance of Power, and they're going to be burning the midnight oil here with special coverage of the President's State of the Union address. That coverage starts here on Bloomberg at 8:30 p.m. Washington time. Meanwhile, we are going to get another read on the U.S. job market tomorrow morning at 8:30 a.m. Washington time. Of course, Biden has been trying to sell the public on his accomplishments for this economy, and at least on paper, it looks good. But, of course, the messaging not necessarily on par. Louise Shaner joining us right now. She's a former Fed economist and former Deputy Assistant Treasury Secretary. And I do want to start there here before we get into the numbers of the jobs report about the overall complexion right now of the labor market. The numbers tell me this is a solid labor market. The numbers tell me that everyone's doing well. When you look under the numbers, Louise, are you seeing the same thing?
Yeah, first of all, thank you for having me on. That's good to be on again. I think it is a solid labor market. I mean, it's not just the number of jobs, it's the unemployment rate, which has been below 4% for 2 years now, which we haven't seen for 50 years. It is the quits rates, which were very high because there was a really strong labor market and people were going to better opportunities, but now are, at a level consistent with a strong labor market. So I think we have a solid labor market. And what we're more concerned about, it's a really good news that we have a solid labor market and real wages are rising. But obviously everybody is worried about what the Fed is going to do and inflation. And so what we're looking for is some continued slowing, but not too much, right? We don't want to have a recession.
Right.
We don't want to have acceleration of economic activity either.
But one thing I'm interested in here, Louise, because everyone still seems to be wringing their hands over the Fed. I mean, we should point out when those rate hikes started, we're now, I don't know, 2 years removed that more or less here. So any lagged effects, or at least the majority of the lagged effects, in theory should have shown up already. So when I look at a blowout jobs report like we got in January, that 335,000 number, and I know that's going to come down in this most recent report, but that's still going to be a number, if you believe the economists, that's going to be tracking probably above some of the long-term averages.
Exactly. So we had 350, I think it was, in January, and 300 in the month before something, and both in the 300s, which is higher than we think is sustainable, right? So this is why we're saying this is a really booming labor market. Those numbers were higher than the average since June, which was more in the 230,000. And so we think that those were sort of temporary, like, the things bounce around a little bit. So we're looking for something more like 200. 200 is still a really strong number. And one of the things that people have been talking about is, because you would have thought before, a few months ago, we would not be able to keep 200 month after month, but immigration has been incredibly strong. And immigration really does provide more workers. It's a supply side shock. It helps the economy. It helps the economy grow. And so I think that 200 is kind of close to sustainable, maybe 175, 180, while immigration remains high.
Okay. I mean, Louise, we know that the Fed has a dual mandate, maximum employment and, of course, controlling inflation. At this stage of the economic cycle, which is the more important mandate?
Well, I think they would say they're getting better into balance, that for the past few years with inflation so high, they were really, really laser focused on inflation. But I think there's still a little bit more focus on inflation. As Powell would say, like, they see inflation coming down. They feel like it's really close to the point where the risks are quite balanced, but they want to be sure that inflation is coming down in a sustainable manner. That's the numbers they're going to use. And so if you see continued slowing in the labor market, that would help assure them that, yes, the economy isn't reaccelerating. Those big 300,000 numbers we saw were not the start of some big upward swing. So I think they're still a little bit more focused on inflation, but it's really getting to the point where it's going to be more balanced, and they're going to be worried that if they don't start cutting rates, they could sort of hurt the other side of the mandate.
Okay, so in terms of hurting the other side of the mandate, where would that show up first? Would it show up in wages? Would it show up in the non-farm payrolls number? Would it show up in the participation rate? What's the number that the Fed is looking at to determine that the labor market requires them to move?
I mean, obviously, they look at that whole dashboard of everything, because especially in this economy and post-COVID, things are just so different that you're not going to say, oh, I'm just looking at one number.
Sure.
But yeah, they're going to start looking at the unemployment rate. Is that starting to creep up? They're going to look at the number of jobs created.
Yeah.
Is that starting to fall more, below what's a sustainable level? So they're going to be looking for that. I don't think anybody expects that yet, right?
Yeah.
I think we're still pretty confident that the labor market is strong.
Yeah.
But it's something that they will be keeping their eye on.
All right, we only have time for one more question, Louise, and I want to kind of get your sense here just about the process right now of the collection of this data. There's been a lot of hay made over the methodology behind this report, the lower participation rate to the survey data itself, and you certainly saw that with that January report. I guess my question is twofold. A, does it matter? And B, if it does, what can we do, or what can the government do to make sure that this data has the same reliability that we've gotten used to ascribing to it?
Yeah, so response rates for surveys are down across the board. The payroll survey of the establishments is good still, right? Like, it's still a pretty good read. But the households have stopped responding, so there's a lot more noise in the labor force participation rate. So it's really unclear what they can do. They've talked about different ways of making it easier to respond, of making fewer questions. Like, that people are working on that. We look at big data to make sure that the data are consistent with, like, the Indeed data and other data. But it just means that you have to put a little bit less weight on little blips up, knowing that, it's not as strong of a sample, and so there can be more noise in it. I mean, one thing they could do is make the sample a lot bigger.
Make the sample a lot bigger, in which case you just need a few more of those people to respond. Former Fed economist Louise Shaner, thank you so much for joining us ahead of the big jobs report tomorrow. One thing they can do is technologically get up to speed and perhaps not rely on phone calls, for instance, or emails.
Yeah, this has been, don't even get me started on that. I understand that some of this is legacy and it's hard to break free from that, but they got to do something, right? I mean, if you call me and, you're not already in my contact list, I ain't picking up.
So a lot of boomers are responding to the survey, but the younger generation of leaders,
boomers?
maybe
Is that what
not.
it is?
Well, it's one slice of the labor market for sure. All right, let's take a look at how the market closed on the day, given that we are waiting for this big jobs report tomorrow. Stocks closing at a record high, whether you're looking at the S&P 500 market cap weighted index or equal weighted index. The NASDAQ also reached intraday highs, and we heard Powell reiterate the same point here, which is that rate cuts can and will begin this year. There's buying on the short end and selling on the long end of the yield curve, and Bitcoin continues to move higher.
Did they ask him about Bitcoin?
I think he had the same thought as when Senator Kennedy asked him about what was going on at the FDIC.
Bunch of F-bombs.
Yeah, please let me not talk about this. This is The Close on Bloomberg.
All right, Broadcom is out with results. The share is moving lower and dragging down a lot of other chip stocks here. In the most recent quarter, they did beat on some metrics, but the guidance giving some people pause. The semiconductor division, of course, the one that everyone's focused on with the boom in AI, revenue of about $7.4 billion in the most recent quarter, and that missed analyst estimates slightly. The street was looking for 7.7. CFRA analyst Angelo Zeno joining us right now to talk a little bit more about these results. And the numbers themselves are somewhat immaterial. I think the longer term story here, Angelo, is really about the AI boom and how much Broadcom is benefiting from that. When you looked at this report, did you actually see that benefit?
Well, I mean, you're seeing the benefit to an extent. The problem is, I mean, we won't really know to what magnitude kind of, Broadcom is benefiting to it right now until we see the actual results. But until we see the breakdown on the call. But when you think about, what they've done in 2023, we've told investors 2 companies out there that really benefited from a dollar perspective in terms of the AI boom. And that was NVIDIA, and Broadcom was really the other big one out there. And you saw it in the share price performance from both of those companies. As you kind of go here into 2024, you're actually seeing an acceleration in terms of a number of trends that we saw start to take place in 2023. So our view as far as Broadcom is concerned, they generate AI revenue really in 2 different ways, both coming from their networking type of business, which is by far their biggest exposure to the semiconductor industry. And that is, one, it's kind of their connectivity play on the Ethernet switcher side of things, which we expect to nearly double here this year. And the other side is their custom silicon business, which is essentially all leveraged to Alphabet. And that's a business that's probably growing from about $3 to $4 billion this year. So overall, they're going to continue to benefit from this theme, we think, in 2024 and thereafter.
And it's interesting, too, that they didn't give an outlook for the current quarter, though they did provide some broader guidance for the full year here. I am curious, Angelo, about the contribution of VMware. I mean, I was looking at the difference in their revenue growth with VMware and what it would have been without it here. It appears that that's an acquisition that, at least in hindsight, looks like it was very prescient.
Yeah, I mean, and as far as kind of VMware is concerned here, it's boosted kind of they're going to boost their software business from about $8 billion to $20 billion this year. Software is going to be about 40% of their total revenue here. If you're looking for about $50 billion, VMware is going to make up 60% of that software business. What's great about VMware is actually in the near term, what you're seeing is most of their business historically has been licensing based. They're actually looking to shift that towards more of a subscription-based business as they kind of roll people over to some higher value offerings. And while that may be a near-term headwind, what that actually does, it actually provides a nice jolt as you kind of go into 25 and 2026. So our view here, as far as VMware is concerned, it actually accelerates kind of the software story. Once you normalize kind of the inorganic growth this year, you're looking at potentially a high single-digit to double-digit growth rate, whereas historically it's been a low single-digit growth rate for software.
Okay, so there's VMware, there's the semiconductor solutions business, which is getting everyone's attention. Broadcom has multiple lines of businesses, which may be, or some people hope, could be a buffer, a source of downside protection if and when there is a AI-driven sell-off. Do you agree that that is something that investors will see as a positive when that happens?
Yeah, I mean, we do. I mean, the fact that this is, I think what you've seen here, at least from Broadcom, different than what you've seen from NVIDIA, is you've actually seen kind of the multiple expand for Broadcom. I think largely because of the improved visibility that you're going to get if you're an investor in Broadcom. Partly because of what you're going to see and get out of the software business now at a much improved growth trajectory. And then the other side of it is kind of the diversification and who they're levered to on the semiconductor side of things, specifically Apple. Despite some of the concerns right now, Apple kind of driving that wireless business, and Alphabet really kind of driving a lot of that custom silicon business. So they really are kind of tethered to some good customers out there. And then again, that software business provides very good visibility during uncertain times.
And of course, the reason why Broadcom is so diversified is because Hock Tan has steadily built this company through a string of acquisitions. Given how given the multiples at which a lot of these technology companies are trading at, is that still a viable strategy going forward for Hock Tan to consider making acquisitions?
Well, we think it's a viable strategy. I don't think it's anything you see kind of here in the near term take place, right? One, they have to digest that VMware acquisition, which has been by far their biggest acquisition out there. And then the other aspect of it is, to your point, the valuations have kind of gone through the roof. And it's very difficult at this point in time to make an acquisition on the semiconductor side of things because of the geopolitical pressures, which is why they focused more on the software side of things. So we do think they're going to continue to focus on M&A, but it's probably not something you're going to see here over the next kind of 2 to 3 years, we think.
All right, good points. CFRA's Angela Zeno with the incident analysis here on Broadcom, which is down in after-hours trading right now, Romaine, because of that disappointing read in terms of its semiconductor solutions business, which gets all the attention because of its link to AI, but certainly it has a lot more than just the chip division.
Yeah, absolutely. But you're seeing a lot of the other chip stocks that move lower. Some actually did report, like Marvell, but a few others that didn't report, moving down in sympathy. And it raises the broader question about AI spending overall. We know there was that flurry of spending, but that was a lot of money that was also kind of in search of a solution, in search of a problem, or of a home, if you will. So you do wonder if that's going to sustain itself.
Yeah, and something else that Angelo was talking about when it comes to M&A, you've got regulators taking a much, much closer look at everything related to AI. So it's something that Hock Tan maybe doesn't want to step into right now.
Yeah, I mean, and Broadcom has been center square. I mean, they got killed, of course, during the Trump administration, and even this VMware deal took forever.
Absolutely. Yeah. All right. Well, of course, we'll bring you any headlines out of the conference call when that does begin. Still ahead, though, we're going to take a look at what investors need to watch for tomorrow. Hint, first word is jobs. This is The Close on Bloomberg.
Well, a big market catalyst today was Jay Powell on Capitol Hill, and Washington's still going to be in focus for the next 24 hours. Let's set you up for what to watch, and we start with the State of the Union address later tonight.
Starting at 9 p.m., and of course, Bloomberg will have full special coverage of that. But just as important as what the content of this speech will be is how he presents it, right? He's an 80-plus-year-old president, and everyone's going to see if he can read the teleprompter properly.
Yeah, let's hope so.
What kind of energy he has, all of that. The presentation matters.
People will pay attention to the presentation. Some people will pay attention to the substance as well. He's got a lot to sort of sell the public on, including his economic agenda. But also here as well, the idea of whether the economy is holding up. And that actually brings us to the big jobs report, which is tomorrow morning at 8:30 a.m. Washington time.
Right. And the big numbers here that you want to pay attention to is non-farm payrolls. Of course, in January, a blistering 353,000 jobs added. A lot of people are saying maybe that was seasonal. It's expected to slow down to 200,000, but 200,000, come on. This is a labor market that's doing pretty well.
Yeah, I think the official numbers, at least on the Bloomberg terminal, are like a 185 or something, which is, we should point out, in the old days, that would be a good, that would be a great month to have 185,000 jobs created.
But unemployment rate.
Yeah, but you know, a lot of people, again, we talk about the numbers and what they show and what people are really feeling. That's a disparity, and that goes back to what you're saying about presentation. The president has to sell this.
Yeah.
And at least for right now, we know a lot of people aren't buying. We got apparently another government shutdown looming. I've lost track of all the government shutdown deadlines.
That was on the calendar. I don't think it's an issue at the moment, so I think we can move past that.
And we have tomorrow a special International Women's Day, Scarlett.
Yes, International Women's Day, and of course we'll have a special lineup for guests. We'll have a lot of female experts, but we're going to talk with Emily Oster, the economist over at Brown University, to talk a lot about the gender pay gap and also childcare costs and how that factors into women's career prospects and their pay.
All right, a lot of great conversations coming up tomorrow right here on The Close. Please tune in. In the meantime, stick around. A full slate of political coverage coming up 5 p.m. with Balance of Power and special coverage of the State of the Union at 8:30 p.m. Washington time.